Chapter 14, Part 3, Convertible Bonds with Non-Detachable and Detachable Warrants, and then we'll look at the fair value election. Now, accounting for convertible debt. When convertible bonds are issued, any value assigned to the conversion feature on the bond price is ignored, and we use the book value method. And I'm going to show you how that's done. We're going to first look at non-detachable warrants, and then we'll look at detachable warrants. Now, we have this example. We have bonds, $10 million worth of bonds with a face of $10 million at 8%, included 15 non-detachable warrants that can be converted to one share of no par common stock for $80. The bonds, you got $10,800,000, and if they had been sold separately without the warrants, you would have got $8.5 million. Company B bought 20% of the bonds, and on January 1st, 2023, when the stock was selling for $135, Company B exercised their options to buy the stock for $80. Both companies use straight-line method for amortization of discount or premiums. Now let's look at our journal entries. Now, when we issue the bonds, we would book the cash, the face of the bonds, and then the difference, in this case, since we are doing a credit, is a premium on bond. Now, at the time of the issue, you ignore the $8.5 million value of the bonds because we're using the book value method since the warrants are not detachable. Company B purchased 20%. They would show investment, convertible bonds, premium on bonds, and then cash of 20% of the $10,000,008. Now, here's how it works, is when you issue the bonds at a premium, that means your interest expense will be less. And when you buy them at the premium, it means your interest revenue will be less. Now let's take a look at the interest payment for the seller. The cash is always going to be the face of the bond times the stated rate divided by 2 because they're semi-annual. We're then going to amortize a portion of the premium. Now, since we're using the straight line method, we always do the premium second, and it's going to be the premium divided by the number of periods, and this journal entry will be the same every single time an interest payment is made. And that, if you notice, interest expense is less for the bond seller. Now, what about the person who bought the bonds? The cash is still going to be the face of the bond, their share of the bonds, times the stated rate divided by 2. The premium on bonds is going to be a credit to reduce it, and if you notice, interest revenue is less. Now we're going to look at the bond amortization schedule for the seller. So, what does it look like when the bonds were converted, the 20%? So they started with $800,000, which means they were going to write off $20,000 per period. 2 years have gone by, and that leaves us a balance in our premium on bonds on the person who issued the bonds of $720. Now let's see what it looks like when they made the conversion. So the convertible bonds would come off the books. The premium on bonds, their share, would come off the books. And common stock would now, since no par, all of it would go to common stock. Now, for the conversion by the buyer, investment in convertible bonds would come off the books. The balance in their premium account would come off the books, and now they would have investment in common stock. Now, what happens if those were detachable warrants? Which means they can be sold separately from the bonds, which means the bonds don't have to be converted in order to exercise the options. So, the rule is, if you have the value of both securities, you're going to use the proportional method, so you're going to do a weighted average for assigning a value by using fair value and then allocating. Or you can use the incremental method, and that you use if you only have one of the values. So let's take a look at a problem. Here we have it on July 1st, 2020. Company A issued 2,000 $1,000 bonds at 102. Each bond was issued with 20 detachable stock warrants, allowing them to buy the stock at $100. Shortly after issuance, the bonds were selling for $98, and the fair value of the warrants were $5. So that's the information that we need. So we're going to do both of them. What happens if we in this case, we know the value of both? And what happens if we only knew the value of the warrants? Okay, you have the value of the bonds and the warrants, so you're going to use the proportional method. So what you're going to do is you're going to take the fair value of the warrants, and then you're going to divide by the total fair value. And you're going to do the same thing for the bonds. Then you're going to allocate the $2,040,000, which is what you received. And you're going to do it based on the percentages, and now you can do your journal entry. And that's where you get the interest. So now let's take a look at our journals. Cash will be $2,040,000. Bonds payable will be $2 million. Paid in capital stock warrants will be $189,720, and discount on bonds will be the $149,720. Now, what happens in the same situation, but all you have is the fair value of the warrants? Then you use the incremental method. You're going to take the cash proceeds. You're going to subtract the fair value of the warrants, and the difference will be assigned to the bonds. Cash is still $2,040,000. The bonds are still $2 million. The warrants will get $200,000, and the discount in bonds is the plug of $160,000. Now, what if an investor bought 20% of the bonds when issued? Investment in bonds would be $400,000. Investment in stock warrants would be $40,000. The cash would be $2,040,000, and they would have discount on investment in bonds. Now, next, what happens if they exercise the warrants? Now, what happens if they exercise the warrants when the unamortized bond discount was $100,000 and the stock was selling at $150,000? Now, remember, since these are detachable, they're going to receive $800,000 in cash. They're going to take the equity stock warrants off the books, and they're going to book it all to common stock. Now, what about the buyer of the bonds? They're going to show their cash. And remember, when the options are exercised, it has no effect on the investment in bonds because the options, again, are separate. The equity stock options is going to come off the books, and investment in common stock is now going to be $840,000. Now let's look at fair value. Now, effects and adjustment to market. Now, the rule is, if the adjustment is based on a change in market rates, then the unrealized gain or loss appears as part of other on the income statement. If, however, the adjustment to market is based on credit risk, then the adjustment goes to other comprehensive income. So now we're going to look at a problem and look at it both ways. All right, we have $500,000 10-year bonds that are recorded using the fair value method. When they are issued, they had, of course, the fair value of $500,000. At the end of the next year, they now have a fair value of $505,000, which means we have a loss because now we have to pay more. So what's going to happen is we're going to have no entry in 2020. We're going to have an unrealized holding loss because we have to increase the value of our bonds on the balance sheet to $505,000. Now what happens? And that shows you your net bonds payable is now $505,000, which it should be. Now what happens if the next year the fair value goes down? Well, now what it's saying is that we're going to have to just buy 6,000 because we already have a balance of 505 is the net value of the bonds. So we're going to have a gain, unrealized holding gain of 6,000 and fair value adjustment of 6, which now brings our net value of our bonds at 499. Now, same problem. What if this had been due to a change in credit risk? So what's the only difference? It's going to go to other comprehensive income. So the difference is that journal entry. It becomes other comprehensive income if it's due to credit risk. If it's just due to market changes, it goes on the income statement. So that ends part 3.